Well, there's some ideas that are bad ideas, and there's some ideas that are stupid ideas. Very rarely can you combine both, but that's what you've got here. A really bad and stupid idea because
Although Kevin O'Leary thinks that markets have not yet reached their bottom, the end is close at hand. In his most recent interview, Kevin O'Leary discusses why there is still pain to come and leverage to flush out of the system despite the tremendous sell-off we've seen in equities markets and cryptocurrency markets, but that the downward spiral is about to come to an end. He thinks that the Federal Reserve's monetary policy is about to change direction, with interest rates increasing at a slower rate in December and easing further in 2023. Keep watching to the very end of the video, when O'Leary outlines exactly how he expects the recovery to proceed in 2019. But until we hear from O'Leary, if you're new to the channel, be sure to subscribe if you haven't already, so we will provide daily content to keep you updated on the latest news.
we're getting close, we're fibrillate right now, trying to figure out what the earnings next year are going to look like. And so every time you have a rally like this, we've had an extended rally, multiple days now to the upside, it's because the belief in the market is that the Fed is finally going to slow after this next 75 basis points and kind of wait and see what happens. And we got a little signal from that up in the Canadian market where they decided not to increase the sort of broadcast amount. They went 50 basis points instead of 75, showing an idea of moderation, if you want to call it that. Now, normally we do not take signals from other countries, but Canada, being the giant trading partner it is, just north of the border, it's the first time in decades I've ever seen anybody wake up and look at what the Bank of Canada was doing, and that's what happened this week. And it actually forwarded this theory, this philosophy that maybe the Fed is going to pause. You have to remember the most hated man on earth is always the chair of the Fed, regardless of who they are, man or woman. Everybody hates the Fed. Everybody second-guesses the Fed. Everybody says they're doing the wrong thing all of the time. You can't make anybody happy when you're the Fed chair. And that's exactly what's happening here. He's trying to, in this case, in Powell's case, engineer a soft landing, which is near impossible. No one's ever seen that happen. However, data coming out this morning proves that we are not yet in a recession. Everybody kind of knows that just by the feeling of the consumer being so strong. And so for the first time in a long time, people are thinking, wow, maybe he can pull this off, and we would know sometime in Q2 next year that he could actually bring in a soft landing, slow down inflation. After all he needs, and the Fed in aggregate needs, the board itself needs, is some indication that the rate of increase of inflation is slowing. That's the key right now. And so we don't have that quite yet. There's a narrative in the market, and I want people to understand this and how CPI data is gathered. So much, 40% of CPI data is housing, shelter. And shelter is a very slow index, and so it takes up to 18 months to actually have an effect on it. But people in different markets are starting to see rent rates slow or flatten or housing prices flatten. So really what we're probably doing in the CPI number right now is over-reporting inflation. And that narrative has been coming in with Professor Siegel, who's been talking about this ad nauseum for the last 6 weeks. But he has a point. You can't deny the fact that 40% of CPI is shelter, and maybe we're over-calculating it. Now, people do this all the time, and I'm guilty of it right now, trying to say, well, here's why we shouldn't believe this number. It's just more Fed beating and more Fed hating and more, telling the Fed what to do. And the truth is, they don't give a damn. They don't listen. They have their own mandate. They're going to do what they're going to do. And I say that'll be 75 basis points coming to a theater near you in the next few days. Well, I've come to the conclusion, because I have my own index to look at, which is my 50-plus private companies, that 50% of this inflation is actually because of supply chain that still hasn't been fixed. Deglobalization, I'll give you just a case study. I've used it so many times. Let's say I'm making gym equipment in Fargo, North Dakota, where I am. And prior to the pandemic, we used to buy all of our metal, our barbells, our screws, some of the infrastructure for the benches from Asia, from China, from Vietnam, from other countries where it was 30% cheaper. We can't get those supplies anymore, partly because the ship that has it on it is stuck at LA Port. Yes, it's still a problem. LA Port has not been fixed yet. And so we are forced to go buy that steel made here domestically. Now, whether that's a good thing or bad thing, we can debate that till the cows come home. However, it's 33% more expensive. So we take those barbells and those benches, mark them up 33%, sell them into an ever-increasing demand market. Our sales have not slowed, but it's 30% more expensive. That, my friends, is inflation. And it's not going to change until I can buy those barbells again in Asia at 30% less, which is no time soon. So the fact is that inflation is self-inflicted by the fact that we are starting to slow down in cooperation with global suppliers. We're fighting with the Chinese, we're cutting off their chips, they're reciprocating. All of that stuff is occurring. And on top of that, people are concerned about domestic supplies of things like semis and oil and gas because it's the only thing you can count on. You don't want to be begging hand in cap with foreign dictators like Venezuela or going to see the Saudis and asking them to increase production when they're just not listening. And so at the end of the day, we have this transition occurring, and that's part of the inflation number. The economy itself, though, proven again by numbers today, is doing very, very well. That's because, again, I'm speculating, $6.7 trillion worth of cash was printed in the last 30 months, still sitting in the checking accounts of the consumer, and he and she are spending it. I don't think it's possible to deglobalize, and I'll tell you why. There's certain product categories, once they become commodities, are better manufactured in low-cost countries. And you know, the idea that you shouldn't manufacture socks in Vietnam because of some protectionism or the fact that you'd rather pay 5 times more for socks, that makes no sense whatsoever. Yet, if you're building a new chip that actually can fuel AI, artificial intelligence, yeah, I can see I'd rather do that domestically and keep that away from our economic competitors like China, who don't want to play in a level playing field unless they're willing to cooperate. And that's the leverage we have over them. So, you know, different product categories, and I would argue energy. We should remain self-sufficient. That was a mistake the administration made. You know, prior to the election, the country was completely independent in terms of energy production in oil and gas, and obviously pipelines were shut down, policy changed. And I think that this current administration realizes they went too fast, too soon, and now we have to pedal back. I'm not trying to play politics, but it'll be reflected in the midterms in just a couple of weeks. And I think what we'll have after that would be very welcome by investors. It would be total gridlock in Washington. That is a wonderful thing, the pause that refreshes, no more bills, no more spending. Let's take a break for a while and then do jump ball in the election, 24 months later. And I think that's a really good outcome, why many people like me are optimistic. I think that act is very inflationary. I think the idea of forgiving student debt is very inflationary and incredibly unfair to generations who were burdened with that debt or in fact couldn't even go to college because they couldn't take on that debt. I have never seen an act more un-American than forgiving student debt. And I hope that that gets stuck in litigation and gets reversed. It's outrageous what's going on there, and that's extremely inflationary. And that has nothing to do with politics. That's just bad policy. Doing nothing is always an option. That never happens in government until there's total gridlock, which we're going to get. Assuming the House flips, nobody knows what the Senate's going to do yet. It's jump ball. But bottom line is, gridlock is a great thing. It's a good thing. Politicians can't get any bills done, and nothing happens, which is a great option because it's a form of certainty in the market. And we've had so much printing of money, so many bills, so much bad policy, regardless of what side of the aisle you're on. And I just detailed my own personal opinion about student debt, which I think is just, the more I think about it, the more my blood boils. It's just so unfair. But at the end of the day, all that stuff gets shut down. And that is what I'm looking forward to and very encouraged by. It's a fair comment. Let's work on that problem. But let's not forgive one cohort's debt when generations past never got that opportunity. This idea of free money for just the select is absolutely un-American. That is not what built this democracy. It's just outrageous. And the idea that you just pick one cohort, they're the special ones that don't have to pay for their debt. I agree with you. Education costs are too high. Let's work on that problem. Let's figure out a new way to approach that. Let's use technology to maybe make it a more level playing field, but not giving one cohort, just one, the special ones, they get their debt forgiven. Outrageous. Well, there are some ideas that are bad ideas, and there's some ideas that are stupid ideas. Very rarely can you combine both, but that's what you've got here. A really bad and stupid idea because you're just fueling inflation. Now, the great news about what's going on between state to state is we're finally getting a competition. Idiot management states are losing taxpayers, losing capital from companies, and lots of movement out of them. California, New York, New Jersey, Massachusetts, people are leaving there and companies are leaving there and moving to places like Colorado, North Dakota, Florida, Montana. I am doing my fair part of that too. I'm moving companies out of California. That place is great to visit, but not fit for business. I would never invest a dime there. Same with New York. I've moved a big project out of New York to Norway, a data center there because New York policy is unstable. And I spend a fair amount of my time on the Hill showing these examples to lawmakers on both sides of the aisle. I'm just one investor, but we make aggregate decisions, millions of them by the day, and those places are uncompetitive. Elizabeth Warren's Massachusetts is not a place for business. And that's why they keep trying to overtax and overtax. They're past 50%, California's past 50%, New York City's past 50%. No problem. People are fungible. They move. They're not stupid. Why would you go sit in a cubicle in a New York high-rise when you can be in great weather in Miami and save a ton of money on taxes? Exactly what everybody's doing. Yeah, I've been quite an investor in the Miami market now for 6 years in terms of my allocation of real estate investments. I would say one thing about real estate that's unique as a sector. Now, normally, portfolio theory would say this: no more than 20% in any one sector, no more than 5% in any one position. That has been a standard in the indexing market for sovereign wealth and pension plans for 100 years. And I abide by those rules in most of the mandates that I'm involved in managing, with the exception of real estate. In our operating company, our holdings in real estate now are at 39%. Which is significantly, it's a heavy overweighting, and the majority of that is in Florida, where we are very positive and constructive about the demographics that are occurring there. Now, I've heard all the arguments about Miami sinking underwater, and I get all that. We've been talking about that for 100 years, and there is always that risk in any coastal investment. But when you look at the demographics and demand for properties and office properties in South Beach or Miami proper or Brickell, or even Palm Beach or other West Palm Beach and other areas where I am an investor, we see this continuing on an ongoing basis. And I have to thank the politicians in New York and Massachusetts and California for this wonderful investment opportunity, because this is why prices there have not corrected and why they continue to be very, very buoyant and demand remains strong. The harder you make it to start a business in New York, the better it is for me in Miami. And so, that's the bottom line. And I talk to Mayor Suarez every day and all the other politicians there. They are very open to business. They understand the advantage they have. They're running around the world with their arms open. And on top of all that, we've got the crypto community, which some people think is going to be the 12th sector of the economy in a decade, and I agree with that theory. Centered, one of the global centers now is Miami. So I spend about 5-6 months a year there just dealing in that sector. We haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone, we haven't had a significant correction, I don't care what market in North America you look at, for 25 years, and that's because of change in demographic and demand for housing, both rental and assumed ownership. But you gotta look at it this way. Real estate cycles are really interest rate sensitive, as you detailed, but these mortgage rates right now are still traditionally very low if you go over a 40-50 year period. I've been an investor in real estate when interest rates are 15%, 1.5. I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. The old adage, they stopped making it a long time ago. Particularly that applies to beachfront properties and vacation properties, and look what's happened in Montana, look what's happened in North Dakota, look what's happened to farmland. These are all investments that I look at every day. Each of them have their own merits or risks, there's no question about it. But at the end of the day, it's a fundamental building block in anybody's portfolio. And the only decision you have to make when you're young is how much debt do I want to take on? And that's governed by the percentage of that mortgage. And so you're right, if mortgage rates go past 7%, and I think the terminal rate on the Fed will be under 5, so you could see some high-risk mortgages at 7. That's still traditionally not a very high mortgage rate. It was a very, very short period, 18 months. And so when you think about an asset class like real estate, it is a very slow turn asset class. The entry and exit fees are very high. You don't flip it, you don't trade it. You really have to think about the cap rate is reflecting. And what I would agree with your statement in '08 with the financial crisis was cap rates went up. And so it's the inverse. So if you buy a building at 4.5% cap rate, which was AAA office towers in Boston in '08, yeah, they spiked up a bit for that 18 months, but there were very few trades in that market. So, these assets people think very long term on. Now, I would agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of a new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less. However, in the case of residential, the inverse is true, because all of a sudden you've got rural communities like Champaign-Urbana and places where people want to live, raise their kids, go to good schools, get more house for the dollar. Those cap rates, or the cost of those houses, have gone up, and the cap rates have gone down, because all of a sudden you don't have to live in Chicago. You can live in Champaign-Urbana, and the lifestyle there on Greencroft Avenue, right on the golf course where I used to live a long time ago, that's a beautiful place to raise a family. And you can still participate in the Chicago community. I do a blend. I like your idea of a blended portfolio. I like a real diversification of duration. When you do rental deals, you want diversification. Just in case rents go up, then you have the ability to reset them at a higher rate if they're shorter term. But that's all part of the portfolio analysis. I do, however, prefer putting in my investments into business-friendly states where you've got the constant demand of entrepreneurs starting businesses, which will bring you more and more customers. I mean, customer acquisition is what you care about in a real estate portfolio. So I prefer places like Florida, like Texas, like Montana, like North Dakota, any state that is pro-business, that is not raising its taxes past 50%, because that is just the breaking point. Remember, when you pay 52% tax, that's the money you can't pay for your rent, because you're giving it to a poorly managed government who goes and wastes it for you. That's what's happening in Massachusetts. That's what's happening in New York. There's a reason these places are uncompetitive. Look at San Francisco. Walk around downtown. That is a war zone. Los Angeles, a war zone. It's a complete collapse in society, because what they've done is they've broken management. They have no way of managing those anymore. They've squandered their resources. They've squandered their money. California is a disaster. Great place to visit. Wonderful to take that drive down the highway, but I wouldn't touch it as an investment. And at night, my goodness, I wouldn't wear any of my watches out. That place is, I wouldn't even walk in San Francisco at night. It is literally a war zone. You wouldn't recognize it anymore. I agree. I mean, you think about that. That market has suffered because of policy, bad decisions by government, bad overall policy, and then, of course, the collapse of society. Nobody wants to invest in a war zone. And I would argue Los Angeles and San Francisco, they are modern-day war zones.
Do you agree that price doesn't matter in the short term? Leave a comment if you found the content interesting. Click in like button. It really helps the channel find viewers similar to you. If you're new to the channel or haven't subscribed to it, click in subscribe button. We post content daily to keep you up to date on the current market and news. Thanks for watching. See you in the next video.